it's a real benefit to be able to have the knowledge, if you will, or the data, and also to be working with the right people. Because at the end of the day, I'm not the bank and I can't make them, give loan dollars if they don't want to. But obviously, we know our market, we're working with the right people, and they believe in the level of analysis that we do, and they know the market as well. So if you have, I don't want to use, cliches or whatever, but if, the sandbox that you're playing in and you have all the ducks in a row, you have a higher degree of certainty for success.
I am Christina Suter, and this is the Real Estate Breakthrough Show, where we talk about the reality of real estate, the mindset you need in order to face the reality of what it is, and tips and tricks to get you moving forward in investing. I am your host, Christina Suter. I have with me Jeff Isenberg from Buckingham Investments, and Jeff actually currently sponsors my Phoebe Pasadena meeting. So I actually have known Jeff for many, many years. I find him to be a professional in his field. I find him to be approachable, responsible, and thoughtful about how he treats his clients. And at least my relationship with him, that's how I have experienced him. So I'm excited to have him here on the show with me and to share him with you guys. So let me give you a minute I'm going to take a minute to read his bio, and then we can start talking with Jeff. So give me a moment here, Jeff. Here we go.
Thank you.
So originally from Montreal, Canada, and a 20-year resident of Los Angeles, Jeffrey is an experienced investor of multifamily property and an investment sales agent with Buckingham Investments in the South Bay area, with the goal of helping both new and seasoned investors learn, plan, and invest to build their net worth. Jeffrey has successfully moved many everyday people closer to financial freedom through real estate investing. A former VP with over 20 years experience in sales, marketing, and contract negotiations for a leading provider of high-end video displays within the live entertainment industry has positioned him well for a seamless transition towards acquiring multifamily properties for SoCal investors. This effectively refocuses his strengths in helping others build their net worth and additional income streams through strategic multifamily asset acquisitions. As with most Buckingham investor and agents, he is active in building his portfolio by following a detailed investment plan, which I know he's going to go through into more detail. He's also the host and title sponsor of the Multifamily Investor Network Meetup that meets on the fourth Tuesday of each month. You can find it live. It will come back to being live, but currently it's by video. This group provides investors with analysis and industry updates into the market, emerging trends, legislative climate, which is very important when you're investing, and creative ways to approach multifamily opportunities in the market. While not pouring over pro forma property analysis, Jeffrey can be found pursuing his passion for travel, classic cars, and watching professional hockey. Now, that is what I didn't know about you, Jeff. So welcome to the show.
Thank you so much. It's a real pleasure to be here, and thank you for that warm introduction. I'll try hard to match your energy level.
Mostly I just want your integrity and your thoughtfulness to show through, because that is my experience of you. More than my over exuberant energy level is not required. It's my particular style. And as my mentor says, stay with your style, because you can do that every show in, show out. So just accept it. But let's talk about what you did before real estate. So 20 years in the live entertainment industry. Live entertainment to real estate, those two don't go together, obviously, in my mind. So tell us how we went from there to there.
Well, it's actually funny how well kind of one career sets up for the other, and it's actually not that far of a stretch. So basically, I moved out here 20 years ago. I had founded a company with my brother, renting specialty video display systems. So these are like the video wall displays and what's affectionately known as jumbotrons. Okay. So we would do everything from, music festivals and rock concerts and corporate launches, pro sports. I mean, you name it, we did it. NCAA, Olympics, MTV, just a lot of stuff, a lot of travel. And, we were set up, came to San Fernando Valley, had an office in Burbank, and just basically kept growing the company. And I'd say somewhere in around the early 2000s, there was a shift in the technology. What started off as a real specialty type of business started to become commoditized, like so many other products. Even the name brands that you know, Sony, Toshiba, Panasonic, started farming out all of their equipment to China. So now everybody had equipment and prices were going down, margins were going down. And obviously after the economy started to go south in late 07, 08, everything became price sensitive. So it didn't matter how great of a job you did or how great your equipment was, you had to compete with, the price points that were out there. And kind of this just continued and accelerated, and it got to the point where I felt that the business model wasn't sustainable, that something needed to be done differently. And we weren't really able to come up with the best way in which to do that. We looked at a lot of different ways, and it just made sense to me that it was kind of time to move on and do something else that would be more financially rewarding and more professionally rewarding. So I sold my share of the company, and at the time kind of sat back and said, okay, well, what am I going to do now, right? I'm 49 years old. I've been doing this, been successful, have everything I need, the home, the kids, the schools, the whole thing. It's all going well, but I'm certainly not, ready to retire by any means. So how do we move forward? And this was in 2017. So this is about 4 years ago. And I had already been an investor for about 3 years. I had started with a 4-unit property in Long Beach, and I bought it, with confidence in what it would do, based on what was already going on in the market here. And that proved to be kind of the best decision of my life. And then 2017 came along, and I'm like, you know what? I really enjoy real estate. I enjoy what it's doing for me, and I kind of see the capabilities, but I don't really know enough about it to be an expert at this point. So I figured, you know what, I'm going to kind of go back to school. I'm going to get my real estate license, and I'm going to learn more about, why this is such a powerful investment vehicle. And did that, quickly got up to speed and became an investment sales consultant. And, it's been a very, very fast progression to the point where now I have a portfolio of clients that I'm helping to purchase properties, and they're doing great. It's a very, very sustainable business model going forward.
I've always respected them. Marty Stone was an unofficial mentor to me. He knows nothing about it because I've only met with him once in his life or once in my life. But the book I was weaned on was The Unofficial Guide to Investing in Real Estate, which he co-authored. And so I've always had a special place in my heart for Buckingham Investments. And, your way of being as an individual doesn't surprise me that that's where you would choose to land, because they have a particular style there that I think fits your style.
Yes, I would tend to agree with that. So it's kind of more about the model of helping people grow their net worth. I mean, at the end of the day, it's all about financial freedom. That's what everybody is in search of. And with that in mind, it was just a natural fit, because a lot of other brokerages are more of a sales model, right? If you're going to go work at a top 3 brokerage, name brand, you're going to start doing 200 telemarketing calls in the first week, and you're just going to try and dig up some buyers, dig up some sellers, and then kind of put some properties in front of them and tell them why they need to buy. We're doing something completely different over at Buckingham. So we're working with everyday individual people. These are people that are working every day. They're not relying on the cash flow of the properties in which to support themselves, but they want a financial future. So whether they're, like a lot of my clients, doctors, attorneys, entertainment professionals, they want to own their own portfolios with the limited time that they have to give towards real estate. So we really allow them to lean on our expertise. We help them throughout the process, IDing properties, but we're really giving them education. We want them to be the experts. We want them to be able to analyze their own deals that they're looking at. We want them to understand the market. We want to keep them on top of the legislative climate to give them the confidence to make their investments. So we're kind of making them the CEOs and the experts, and then getting those properties turned over to professional management. And they're just kind of sitting back and getting all the benefits of owning their own properties, as opposed to some of the different models that are out there for passive investors.
One of the things we talked about is, Buckingham. I tried to show on the website, Buckingham Investments, sort of like your guys, intention about, plan, learn, and invest, right? And here's some of the, the podcasts that you guys have available on the website. And I actually really like the homepage, where it specifically talks about, what do you want to do? You want to learn, you want to plan, and then you want to invest. Right. And so it's really about, education first, creating a strategy, which you guys actually sit and you actually discuss with your investors, what strategy is going to be best for them before you ever march them towards towards a building.
Absolutely.
And I think that is, to me, so vital. I can't count the number of meetings where I have said, do you need money to be a successful investor? Not really. You need to be able to invest. You need to be able to have a network, and you need to be educated. And so whether you've got money, which is helpful and starts you in a particular place in the investment market or in real estate, your education and your capacity to research and to plan is the definer of your success. Otherwise, it truly is just luck. And you are a great believer in that. And Buckingham is a great believer in that.
Absolutely. And the interesting thing is that I kind of put myself in the shoes of my investor clients, because if I turn the clock back to about 8 years ago, I know that you can do well in real estate, and I've always wanted to purchase property. But let's face it, I was an executive in the live events business. I didn't know a damn thing about buying a property. But luckily, I knew one of the founders of the brokerage in Marty Stone, and he had a very simple approach to it and kind of laid out how it works. And I remember saying to him, I said, I hate to use the term no-brainer, but when we're talking about a long-term buy and hold strategy in this market, I get it. There's nothing here that's going to make me overly nervous about getting started or investing in property. So I said, this is great. But my concern is what happens after you buy the property. And now I'm kind of up in the San Fernando Valley. I've got multifamily in Long Beach. What happens, when the pipes start leaking and the tenants stop paying? Because, inevitably there's challenges in real estate, risk and reward, right? It's the end of the day, something's going to happen.
Absolutely. Not a question.
But you're going to make your money, right? So that was kind of like the biggest thing that I struggled with, is kind of post-close. Is like, do I really need the headache? Because I got a lot of headaches right now. And, it worked out great. We were able to rely on some fantastic partners, which we love to provide referrals, everything from property management to the best lenders, escrow, just people that are true professionals in the field. And we literally work with people that are, it's like, okay, I'm an attorney, I'm busy doing the legal thing all day. How do I do this? So it's kind of like, okay, well, these are the guys you want to talk to on the lending side. These are the guys you want to talk to on the property management side. Let's start looking at the market. Let's talk about, first and foremost, what I like to call the Buckingham model, or a financial model. So it's not just, okay, yeah, we're providing a lot of education, but we're actually doing long-term investment planning. So for many people, it'll go and say, okay, I'm, earning so much money and I want to retire in 15 years. I'm going to go to my financial planner and they're going to tell me about all these great mutual funds that average, 7, 8, and 9% over the last, whatever it is, 5-year, 10-year timeline. And they're going to say, okay, past performance is not a guarantee of, future success. But if we kind of rely on these numbers and we look at your timeline, you will need to invest so much money over so many years to have a net worth of whatever that amount is in the future. Well, what Buckingham has been able to do is take real estate and use it as a conduit within the same discussion, if you will. Only the returns are so much higher in real estate because we get the benefit of leverage and other people's money. So we don't have to put down 100% in order to reap those financial rewards. So our returns that we're shooting for in the market are 25% sustained annual. So when we sit down with an investor who says, okay, I have 200,000 and I'm good on a 20-year timeline. Okay, what does that look like in 20 years at a sustained rate of return of 25%? And it's actually close to like $17 million. And they're sitting there going, how's that possible? I'm like, come up with the future value of money equation. That's been in finance for a long, long time. We're just taking a page out of their book and applying it to real estate.
You described it so well. When you have a vehicle that performs well, and generally performs as well as the stock market, one could say in general, right? It appreciates, it has cycles just like the stock market does. It appreciates in its core value, just like the stock market does. It has cash on cash returns. I would say in some ways better cash on cash returns than the stock market does. It has cash on cash returns, but you take a vehicle, it's an investment vehicle. But then you talk about, I'm going to now take that vehicle and I'm now going to leverage it, which means my money now has a multiplier of either 2 or 3 times, unless you want to go all the way to 20. I know, I'm getting there. I really am. Unless you want to go all the way, I'm a conservative girl. I 30 years, I'm a conservative gal. Right?
Or you can help you.
You could, I know you can. Or you can go all the way to 20% down, right? And then you have 4 times. You've now taken that return, the return that you get on this asset, and you have multiplied it 4 times because you get to keep the return. The bank doesn't keep the return. The bank doesn't keep any part of, they don't get to participate in the growth on your capital. They get a flat rate called a check at the end of every month saying, thank you for letting us borrow your money at this interest rate, but I'm having my appreciation is outstripping that interest I'm paying on that loan, right? And so you get to use their money while you gain greater appreciation, which is what leverages a 5%, even in the Midwest. I know you specialize in the Bay Area, and I know that there are huge appreciations in the Bay Area, and it is a bit of its own investment scenario by itself. And from my mind, right, in my mind, I've owned in California and Knoxville, Tennessee, and Texas and Hawaii. And so I've owned in multiple places, and each one market has its nuances or its pattern, right? So when you invest on the West Side into multi-units, it has a particular pattern, which I actually had to get reacquainted with, which actually another Buckingham agent reacquainted me with the pattern that works in the West Side markets. Because I kind of went, doesn't work as far as I'm concerned. And he went, oh no, it does.
Oh no,
no, it does. Let me educate you, old lady. And I'm like, good, educate me. I need a refresher on my understanding of apartment buildings. But he talked about how really you're investing for appreciation and not investing with a focus of cash on cash, because you're doing this 20-year horizon line where you're outstripping interest rates with the growth on the property and currently growth on rents. I mean, right?
Yeah.
I assume this is the conversation you have with your clients every day.
Every day. But the beauty of it is that over time, right, you have a period of high inflation that we're entering right now. You know what? Those rents are hedged against inflation because they're going to go up as well. In fact, we just got the consumer price index numbers for California last year through it was either April or May is 3.6% annual inflation. We're able to add that to a 5% base rate for rent increases going forward for 2021, starting in August, if you're not in LA City, which has more restrictive rent control, so Bay Area cities, with the exception of San Pedro, you can do an 8.6% rent increase, provided the market will bear that. So you are getting your appreciation on the value of the building, but guess what's happening over time? If your cost base stays the same, especially in a 2 to 4 unit property, right, where you have a 30-year fixed mortgage, well, at 25% down, right, you have, or even 20, if you're doing owner occupied, you're getting this, phenomenal leverage depreciation. But guess what? Your rents are appreciating as well. So what happens is at the end of your investment plan, you're getting your cake and you get to eat it too, because you're getting cash flow that's going to be on par with out-of-state investments, but you're getting all this appreciation, which is real money. You know what I mean? You sell a building and guess what? You've got a bunch of cash, or you can do a cash out refi, which also is a non-taxable event. Like you need money for some, future life milestone, trip around the world, kid's wedding, whatever you want to do. Hey, you know what? Maybe we'll do a refi on a property and we'll pull out a couple of $100,000. There's some tax-free money for you. So there's just so many benefits to real estate that make it, in my, mind, completely unbeatable as far as an investment.
When we talked about the power of leverage, and we talked a little bit about how it's a working asset, right? And like you just talked about how, yes, you can continue to increase your rents, which increases your cash on cash, especially if your note is staying stable, but you're increasing your rents by 8%, 8 point something percent every year. Obviously, you're outstripping the note, right? So now you get to keep more and more and more every month of the cash flow because your note number is staying the same. You haven't even talked about yet how when you invest in a multi-unit, generally the multi-units are attached to a cap rate. And so because it's attached to a cap rate, every time you increase $1 of rent, you
increase the value of the property.
Increase the value of the property.
By a multiple, and same with gross rent multiplier. By a multiple of every $1 of rent, can be attributed to value as well. So there's two metrics that we look at, definitely cap rate and GRM.
Right, when you're comparing it against a cap rate, which a lot of the larger buildings are basically cap rate. I use GRM because I'm an old school investor. I'm not as keen on cap rate, but because I love I can stand in front of a building, and if you tell me what the income is on the gross income on the building, I can give you an idea of what the price is I'd be willing to pay on that building. Up until I was re-educated by Buckingham Investments on how you can invest in the West Side and have a different model, right? There's different rules of the road, which we'll get to in just a minute. But what was I trying to get to? So yeah, so the cap rate. So there's an actual financial model, like for every $1 of increased rent, I think you divide that by the existing cap rate, and that gives you your it must be divide versus multiply. Divide by the existing cap rate, and that tells you how much more valuable your building has just become.
Yes, basically how we're doing it is, or how I like to do it. I can't speak for some of the agents and brokers, but everything is data driven, right? So if we're putting an offer in on a property and we want to go into contract, we're going to look at the list price or the offer price, and basically what does that mean to me? Absolutely nothing until we start looking at the income of the property, and that's going to tell us everything we need to know about how that property performs and what cap rate and GRM is. So we look at it on the current rents, and we'll look at it on the market rents because we want to see what the upside is. But setting an offer price and establishing value, we have to look at everything else that's similar that's sold in the area. We have to do a fairly detailed comparable summary of other properties. And then we can look at what that specific pocket trades for, because if you're down in, let's say, Rose Park South in Long Beach, and you're going to compare that to the Poly High area, buildings trade at different cap rates and different GRMs. So much so that recent property that I sold on 10th Street has a very different cap rate, believe it or not, from properties down south of 7th Street. Like literally 4 blocks to the south, you're closer to the water and the properties have a lot more value. And this is especially important in the 5 and up space, because when you're going to get into contract and you're calling on your appraiser to get value, that determines your loan dollars. And by the time that appraisal comes in, you're already non-contingent on the deal. So if the appraiser doesn't agree with your value, well, hello, Mr. Investor, we came in $100,000 light on the appraisal, and your earnest money deposit, you basically have to follow through on the deal. You need to bring in an extra 100,000 to the table. That's a difficult conversation to have with a client, because you didn't do your homework properly in establishing what those proper cap rates are for the area. So that's where we kind of really excel. We're going to get into the data at the tightest level and know what the GRM is in that area and know what the cap rate is that buildings trade at. And then we're going to go back to the subject property and say, hey, wait a minute. $2.5 million for this 8 unit, this doesn't make sense. This isn't going to appraise. If we can't get this at 2.35, we're playing with fire here. So we like to get our investors into the deals with as much, I want to call it, relative certainty that exists. We're going to let everyone see it from every angle, and we're going to make our decision based on that. And 99 times out of 100, we're going to be right. Sometimes there's always appraisers that don't agree. And then you kind of have to look at it and go back and say, okay, well, here's what we're looking at. Where, show us what you're seeing, and look to come to a solution that way.
So, as I was going to ask you, as a commercial real estate agent, how do you treat your clients and support them? But I think you have well answered the question.
I'm going to treat them like gold. You're going to treat them.
Well, you're going to treat them like gold, but you're also going to treat them like investors. I mean, you're going to treat them, you're going to treat them with an eye to what asset is appropriate for them. And you're going to educate yourself and them on why you feel that's the case.
Oh, for sure. I would say, taking it a step further, I'm actually invested in their success, because I feel that as a commercial agent, my business is really my value and my experience and what I bring to the table. So I've got to be able to kind of put that forward and inject that into the deal. My clients have to be able to leverage that experience and that knowledge to get success. So, rest assured, there isn't going to be anything that gets overlooked in the process. There's never going to be a conversation after the fact that says, how did you miss this? Or why didn't you tell me about that? It's like, no, we looked at it, we put it under the microscope, we discussed it for hours, and we know what we're dealing with going in. And it's been great.
So let's move to the next piece where, basically we just talked about why you need to spend all this time on your due diligence, why you spend your time educating yourself in particular, and then your investor, right? Because you guys are meant as the commercial real estate agent. One of the things that you offer, the depth of the value you offer, is your level of knowledge and professionalism in your market, right? Which they may, as an investor, they may not even have, right? Especially if I'm moving into a new market, even if I move from Pasadena to the West Side, you're much more of an expert in the West Side and its dynamics and its rules of the road than I would be, given that everything I've ever owned was either in the Valley or out of state.
Yeah.
Right. So, so let's talk about a deal that went wrong, because we just talked about how it can go wrong, right? You're talking about the warnings of the different places where it can go. And let's talk about a deal that went wrong. What went wrong? How did you solve it? And how did you learn from it?
Okay. I would say a great example would be what I was just talking about, is not coming in at appraised value. I was working on a substantial deal, north of 4 million, 16 plus units. And sure enough, the appraiser came in light, and they said, you know what, we're off here. We're not giving you the cap rate you're thinking because of the proximity, or rather lack of proximity of this building to the beach, by several blocks. And, we don't just look at cap rate and GRM, we're also looking at all of the other metrics, price per door, price per square foot of comparable buildings. And like everything in our mind was like, yeah, this is, the value's there. That appraiser on that day, he's like, no. And we were literally several $100,000 light on the appraisal. So we're like, okay, well, what's happening here? Well, it goes back to strength of team. The lender that we're working with, our lender partner, kind of looked at it and they said, okay, the bank we're using, they're looking at your pro formas, they're looking at your underwriting. They underwrite so many deals. They're kind of experts in the area as well. They're on board. They like the deal. They're seeing what you're seeing. So basically, what they're going to do is basically up the loan to value from 70% to 75%. The loan dollars into the deal do not change one iota. You guys are still putting down the same amount of money, but the rest of it is going towards what we'll call the shortfall, if you will, in value. And that's it. We're good. We believe in the deal, and we're just going to play with the LTV, and it's the same. But now we have to deal with the client perception that maybe he's thinking, why do you have me into this building?
That's
that's not worth the money. Why am I buying this building? And the beauty of it is we do such a deep dive in the pro forma, and we go back to the numbers, and this goes back to cap rate and GRM. We had about between 15 and 20% upside in rents. So we can see what other buildings are trading at. And based on the area, once we get those numbers up, we're going to have an increased value on the building of $450,000 to $500,000. So as quickly as they can stabilize it and get the rents there, forget cap rate in this part of the conversation. We're going back to GRM of the area. And we're saying, this is the money you're making. We disagree with the appraiser. That's one person's opinion. Your loan dollars don't change. And we all collectively sat down and agreed that the appraisal is a means to an end to get the loan. And we got the loan that we wanted, and we closed, and everything's going great with the building. So, you're kind of turning lemons to lemonade at that point, right? It's like,
yeah.
Is the value there? Is it not there? Well, we believe it to be there. The bank believed it to be there, and we're just kind of moving forward.
I like that solution. What's in there are things like you advocated for your client, right? You went to the bank and you used your team in order to help advocate for the client. You were able to talk the client through the differential, the understanding between, I thought it was worth this and now it's worth that, but it's still a valuable building. It's still going to perform and perform well, because you were able to point out to the performers and what was required to make the building continue to grow the way they wanted, that hadn't moved. The original hope of the building growing hadn't moved. So it sounds like you walked through the whole trajectory with the entire team, because it does, you have to get the investor on board, you have to get the bank on board, you have to get your agency on board. Obviously, the agency was already on board. Buckingham already knew their homework, but you have to get the whole team to work together in order to get that to close. What did you learn? What did you learn as a commercial real estate agent from that?
I was going to say, maybe on some days I'm not as smart as I think I am, but no, that's not really
perfectly
the answer.
Fair thing to say.
No, actually, what I really learned is that it's a real benefit to be able to have the knowledge, if you will, or the data, and also to be working with the right people. Because at the end of the day, I'm not the bank, and I can't make them, give loan dollars if they don't want to. But obviously, we know our market. We're working with the right people, and they believe in the level of analysis that we do, and they know the market as well. So if you have, I don't want to use, cliches or whatever, but if, the sandbox that you're playing in and you have all the ducks in a row, you have a higher degree of certainty for success. Because at the end of the day, we don't know what's going to happen. We have people asking us all the time, is it really a good time to buy? What's the market going to do? And we're like, we're always able to go back to the long-term investment planning that we talked about at the beginning, right? We're going to invest so much money for so many years, and we're going to try and get the sustained rate of return, whether that's 20%, 25%, 30%, whatever we're able to achieve. We're going to go back and look at it and say, well, at the end of the day, the appraiser said one thing, the bank's on board, you don't have to put more money in, it doesn't move the needle on your projected returns, and you're looking to do this for the next 20 years. So what is it that is the issue here? So we're able to rely on the data.
Makes sense. Okay, last question. You used to own a small business of your own. You are now a commercial real estate agent at, I think, a lovely firm, Buckingham Investments. You're using real estate as your retirement vehicle. You don't have to. It makes sense that you do. But why, if real estate can go wrong, which it does, why use real estate as your investment vehicle? And what does financial freedom mean to you? Right? What's the why? Right? As to what financial freedom means to you as an image in your head, and why use real estate to break through to that?
Great question. So I would say what real estate offers for me as an investment vehicle, first and foremost, and even, as an agent, is freedom. So it's a lot of freedom that I didn't have in what I like to call my past life, right? So if I'm working with a client and they're doing this big music festival or IndyCar race or whatever it is, I'm getting on an airplane on a Thursday morning, I'm flying across the country, I'm at the event site, doing nothing more than client maintenance, right? Trying to get an hour of FaceTime, maybe grab a lunch and what have you, but my time is not my own, right? Because I could be in Denver or Cleveland, and you know what? I'm just already thinking of, when can I get out of here? In all honesty, it's like, can I leave Friday night? Can I get on a Saturday morning flight? Like, how soon can I be home and doing the things that I want to be doing? Because as much as I enjoy my business and success and being with clients, at the end of the day, I'd rather be home doing something for me, especially when the hours just seem to be endless. It'll take as much out of you, as you're willing to give it. As I was growing that business, I spent a third of my life on the road, living in hotel rooms, hopping on planes, and well, it sounds all fine and groovy, but it gets tired after a while. It's just not something that I wanted to do. So now I have the freedom of time, which is huge, because basically I can manage my schedule from day to day. I can work from just about anywhere. I've got a phone, I've got a laptop. I can do whatever I need to do much easier. And the best part of it is I get to pick and choose the people that I work with. I've had 20 years of dealing sometimes with difficult people, and I just didn't have the choice of whether or not I could take that business or not, because there's overhead, there's equipment loans, there's warehouse leases and employee salaries. I don't have any of that now, which is beautiful, right? There's no headaches there. And on the odd time that I can, I'm starting the client relationship with someone and I'm kind of getting the vibe that this person might be, exceptionally difficult to deal with, and maybe a lot of, problems are coming down the road, I have the choice to say, hey, you know what? I don't think I can help you. You know what I mean? I don't think we're a good fit to work together. Then I just, go about my business and, dealing with the people that see the value in what I do. So for me, that's the best. It's really about the freedom of time and freedom to, spend your days how you choose.
Jeffrey, thank you. Thank you very much. Thank you for being a sponsor of Phoebe Pasadena. Thank you for taking your time today to do the podcast. Thank you for presenting at my meeting in the future.
I'm looking forward to that as well.
Yeah, and thank you for being a sound and, like I said, thoughtful, and proving that you're a sound and thoughtful human being that really is about helping an investor or somebody who wants to be a professional investor move their portfolio forward over 20 years of a long-term return that can hit, I personally say 15 to 20%. You say 20 to 25%, but a stable all day long on a stable return on a leveraged asset that does well as a commodity. So that means it goes up in inflation. So, you know, it's really an investor's point of view. When you think about your portfolio, whether it's stocks, bonds, gold, cars, antiques, that's really the focus that you're bringing to your clients and that level of professionalism. So thank you, Jeff.
Thank you so much.
This is Christina Suter with the Real Estate Breakthrough Show. You can find us every week, every day on Spotify, iHeartRadio, iTunes, as well as on YouTube and Roku TV. Tune in next week for another show.